Hey everyone, Dave here, and welcome to Am I Catching a Falling Knife? Today, we're talking about Tapestry, ticker TPR, which just took a nosedive, dropping about 27% in the last few days. So, should we catch this falling knife? Let's dig in. Let's start with what triggered the plunge. Tapestry's Q4 FY 2025 earnings landed with a thud. Revenue came in at $1.56 billion, up just 2% year-over-year. But the real kicker was the guidance. Management now expects full-year revenue of $6.2 to $6.3 billion, well below the $6.6 billion Wall Street was hoping for. The culprit? Softer demand in North America and a slower-than-expected recovery in China. Add in some margin pressure from higher promotional activity, and you've got a classic luxury slowdown meets margin squeeze narrative. So, what is Tapestry, and where do they make their money? Tapestry is a global luxury accessories and lifestyle company, with Coach as its flagship brand. About 60% of sales come from North America, 25% from Greater China, and the rest from Europe and other regions. The business is heavily retail-driven, with a mix of company-owned stores and e-commerce, no franchise model here. Their structural strengths? Strong brand equity, high gross margins over 65%, and a loyal customer base. But there are vulnerabilities, heavy reliance on North America, exposure to discretionary spending cycles, and a crowded mid-tier luxury market. Let's zoom in on the income statement. In Q4 FY 2025, Tapestry reported $1.56 billion in revenue, with a gross margin of 67.1%, still strong but down from 69% a year ago. Operating margin clocked in at 13.2%, and net income was $148 million, or 0.61 per share. For the trailing 12 months, free cash flow was $780 million. The balance sheet shows $1.1 billion in cash and $3.7 billion in debt, so net debt is a little over $2.6 billion. Most of their operating expenses, store leases, salaries, are relatively fixed in the near term, which means any revenue shortfall hits profits hard. Now, let's translate the narrative into numbers. Management's new guidance is about 5 to 6% below prior street expectations for revenue. With gross margin under pressure, let's say it slips another 100 basis points, and fixed costs staying put, I estimate operating profit could fall 12 to 18% below previous forecasts for the next couple of quarters. That's the ugly side of negative operating leverage. When sales disappoint, profits can drop much faster. So, in plain English, a 5% revenue miss could mean a 15 or more hit to operating income. That's an estimate, but it's in the ballpark. Let's run a quick discounted cash flow valuation. Here are my assumptions, all based on management's guidance and recent trends. Near-term revenue growth, flat to plus 2% for FY 2026, then a slow recovery to 4% by 2028. Operating margin, 13% near-term, gradually recovering to 15% if cost pressures ease. Discount rate, 9.5%. Terminal growth rate, 2.5%. Plugging those in, I get a base case fair value of about $38 per share. If we stress test for a bear scenario, flat revenue, margin stuck at 12%, fair value drops to $28 to $30. On the flip side, if luxury demand rebounds and margins snap back to 16%, the bull case could be 46 or higher. All numbers are rounded for sanity. Now, a quick multiple sanity check. Tapestry is trading at about 7.5x forward EBITDA and 9x forward earnings, well below its 5-year median of 11x EBITDA and 14x earnings. For context, Capri Holdings, think Michael Kors, trades at 8x EBITDA, while Ralph Lauren sits closer to 12x. So, Tapestry looks cheap on a headline basis, but that's assuming earnings don't keep sliding. If you're looking to catch the knife, here are 3 analytical buy levels, not recommendations, just frameworks. Level 1, $38, anchored to my conservative base case fair value. Level 2, $32, pricing in further margin erosion and a slower recovery. Level 3, $26, deep value/forced selling zone if the thesis worsens or another guide down hits. Again, these are not buy recommendations, just analytical levels for those who want to stress test their courage. Here are the big risks to watch. North America same-store sales trends. Any further weakness here is a red flag. China recovery. If reopening fizzles, the bear case gets real. Promotional intensity. If discounting ramps up, margins could keep sliding. Competitive pressure from both high-end and value brands. Guidance credibility. Another guide down would break the thesis. If Tapestry can stabilize margins and show even modest growth, the story could upgrade. But if comps go negative or management cuts guidance again, it's time to reassess. That's the rundown on Tapestry, luxury's latest falling knife. Remember, this is analysis, not advice. Do your own research, consult a professional, and don't let FOMO drive your decisions. If you've got feedback or want a specific stock in the hot seat next time, let me know. Until then, stay sharp out there.